Welcome back to Total Money Management. We're back for part two of the Anti-Fragile Investor. I'm back with Steve. How you doing, mate?
Good, mate. Good. Big drum roll. Big
Yeah.
drum roll.
Yeah.
I got to say, I'm really excited about this because I think the anti-fragile investor is sort of it's a bit strong to say the holy grail, but in my mind, it's really close.
Well, I remember when we first started working together. When was that? 8 years ago? Maybe
Yep,
long,
yep,
maybe longer now.
yep.
Maybe 10 years. It was something that you talked about then,
Yeah, yeah, yep.
and you've always been passionate about helping people build and kind of build a structured portfolio that outlasts time and outlasts all the volatility.
Yep.
So I think it's a long time coming. Last 2 weeks ago now, or 3 weeks ago, by the time this is released, we went through part one, which was a lot about what the definitions of an anti-fragile
Yeah, yeah.
portfolio are, what Taleb talks about, and I think this time we'll go through how do you build one. But let's recap quickly. So there's some key points from last 2 or 3 weeks ago where we talked about coffee cups and we talked about weights
Muscles.
and muscles and all sorts of analogies. Give us an overview.
Yeah. Okay. So just to refresh people's minds, something is fragile um, if it breaks. And the idea in investing is you've got to survive to get to be able to benefit from upside, right?
Yeah.
So you don't worry too much about the upside. What you want to do is say, how do I avoid the negative?
Yeah.
Right? Now, if you're fragile, i.e., a coffee cup, if the coffee cup says, listen, just put the coffee in, leave me on the bench. I don't like too much action, volatility. Don't move me around too much, right? Because that increases the chances of falling over. If you drop me off the table, end of story. There's no more coffee cup,
Yeah.
right? I.e., I didn't survive one event. That's it. So the next one is robust. And that is essentially, if we use the coffee cup analogy, it's a little bit like saying you can drop the cup, it breaks the handle off, but you sort of look at it and go, okay, well, I can still use it as a coffee cup.
It's like one of those thermos.
Yeah, yeah,
You can
yeah,
drop it a
yeah.
bunch of times.
Yeah,
And
yeah.
it'll be right for a few years.
So, but again, the idea being, well, okay, I had a really bad event, i.e., the handle fell off or broke off,
Yeah.
but I've recovered,
Yeah.
right? I can still use it as a coffee cup.
Yeah.
Fragile is like you dropped it, that's it, end again. You got to get a new coffee cup.
Yeah.
Anti-fragile is, and this is it's a little bit tricky because what we're saying with anti-fragility and Taleb is saying you benefit from harm, right? So if you think about you get the flu as a child and it harms you, but you come back stronger because your body grows and gets an immune system,
Yeah.
right? So you actually benefit from, like if all the kids go to daycare, right? They all get flus, sneezes, coughs, and colds, but then their immune system builds up, right? So we were talking about weightlifting. You do weights, which actually harms your muscles,
You get sore.
but then your muscles go, right, I'm gonna grow back bigger and better.
Mm.
And so again, the short term is harm, but your response with your muscles is, okay, I've got to fortify myself, right?
Yeah.
So like the immune system.
Yeah.
Okay.
That's a good
So
way to put
that's
it.
the three sort of non-investing um, definitions or the ways to think about it. Um, in the first stuff. We can get on to the mediocristan and extremistan perhaps later on, but it's really important at the start just to get that idea of, particularly for investing, fragility, robustness, and anti-fragile
Yeah,
because
and understanding how to self-diagnose is a big thing. So
absolutely.
I'll use myself 10 years ago. I would have come to you and said, "Mate, my portfolio's so robust or so
Yes.
um, anti-fragile. It's fine. What are you talking about?" But it's only until when you've gathered the knowledge and understand
Yes.
what it actually means,
Yeah.
you can't self-diagnose. So I think part of this special part one and part two is giving people the tools to be able to look at their portfolio and assess that, and then how to build one themselves if they want to as well.
Yeah. if you look at it, let's look at it in investing terms, right? If you say, "Oh, Steve, I've got, here's my portfolio," um, or you look at your portfolio and you go, "Oh, I've got like junior mining stocks that are explorers that haven't got a lot of cash."
Mm,
So you look at that and say, "Okay, if they had a bad event, that could kill them." And what you find is, particularly in mining stocks, is if you get like a GFC type event, they struggle because then they don't have access to credit to continue the exploration.
mm,
So they might have to shut down the company. They might have to defer. Right.
yeah,
They might at some level they might say, well, look, we've got a really great resource. We'll approach Rio or BHP or someone else to buy it or a takeover or something.
yeah.
Right. So they're the things that are really, really fragile. The other ones are like basically anything that's really high risk, right? Biotech, right? We're at stage 4 trials to cure cancer. Oh, this is great. Actually, no, it didn't work.
Like,
Right? Dead end.
almost like frontier markets. Like, you got tech markets and frontier markets that are new. They haven't been around very long, but the earnings projections are wild,
Yeah,
and it suckers you in.
yeah,
And we'll talk about the barbell strategy in a bit, but that's where most people weight the barbell too heavily
yeah.
towards those frontier
Too
and
much risk,
fragile. Yeah,
right?
exactly.
So the main point is always bringing it back to, can I survive?
Mm,
Right? If you have upside, well, it doesn't matter, right? The question in investing is saying, how do I avoid, as we say, don't lose money? The first thing to do is say, okay, well, if there was a bad event, I don't know what the bad event is, but if there was a bad event, how would I be?
mm,
If you said, oh, I'd be fine, it's like, okay, well, that's good. But to do that, you again, like you said at the start there, you've got to be able to look at your portfolio both on an individual basis and look at it at an aggregate level and say, oh, I've got 20 junior mining stocks. Okay, that looks pretty fragile.
yeah.
But if you've got a portfolio of, say, and this is where we can talk about robustness,
Well,
you've got,
before, sorry to jump in,
yeah,
but 20 junior mining stocks, I would argue, would be better than 3 junior mining stocks, because at least if you've got 20,
yeah, yeah,
2 of them might,
17 will go broke.
yeah, 2 of them, 3 of them might survive. But if you've got 3,
Yeah, yeah,
then the
yeah.
odds on it's gone.
Yeah, yeah, that's right. And that's one strategy that Ben Graham talked about,
Yeah.
right? Basically statistical arbitrage. It's like, buy 50 companies, 30 will go broke, 10 won't do anything, but 10 will go gangbusters,
Mm,
right? And that's a valid way to approach it.
yeah.
Particularly with junior mining stocks, right? So,
I've learned
but
the
if
hard
you
way. Just
yeah,
week
yeah, well,
1.
Ruby Energy, wasn't it?
Ruby.
Um, the next one is robust, right? So robust is things like they're the things that pensioners have in their thing, right? I've got Telstra, I've got Woolies, I've got Wesfarmers, I've got the 4
And the
banks, right?
banks, yeah.
You're not gonna There'll be a steady growth, they pay a dividend, but more importantly, in the context of what we're talking about, they will survive, right? Now, just to in the GFC, when they crashed, I remember buying Commonwealth Bank at 22, I think, or 26, after it had fallen from 65, right? Now, the important part is it wasn't a penny stock where you went, oh, okay, that's the end of the show, and you lose your money,
Mm,
right? And now Commonwealth Bank's at like 170. But my point being, to get to 170, you've got to be able to say it will survive a global financial crisis,
mm,
right? So that's the robust thing where you can say, oh, I held Commonwealth Bank. I bought it originally at about 28 in 2000. It went to 65 and then it fell to 26 or 22. I bought some more. But my point being, even at 65, if it falls down, you can recover,
yeah. It's
right?
you can look at it on a aggregate level basis and say, right now it's pretty well valued or cheap. I'm gonna feed some in,
Yep.
versus at 65 at the time, it was probably overvalued.
Yes.
And now it's obviously insanely overvalued. So
Mm.
It's about, and we'll get into this as well, your asset allocation at certain
Yeah,
points
yeah,
of
yeah.
the market as it shifts.
Absolutely. So you look at those. So again, the robustness is the idea of, yeah, we had a GFC event. It was really awful, but I didn't die.
Yeah. Yeah.
Right? I recovered. Now, anti-fragile is where you actually say we had a really bad event and it was fantastic.
Yeah,
Right?
to your point, I benefited from it.
Yeah, yeah.
Yeah.
I was short the market and the market crashed and I made heaps of money.
Yeah.
Right? So again, that's where it requires a sort of different way of thinking. Now, to give you an example, I had when COVID hit, I had already had a short on the S&P, and I was down 80% on my options, on put options,
Yeah.
and it was in November, I think. I think it was November 2019. I thought they didn't have long to go. Yeah, they had about a year to go, but they were down 80%. And I thought, oh, well, I'll just double up.
Mm.
So I just doubled up. I think COVID hit and they went up 800%,
Yeah.
right? That's where you say, I've benefited from a sort of negative event.
And it's again, to what you've just said, it's about changing your perspective on things, because I'm going to make my point in a roundabout way, but people will start off by saying, "But Steve, you can't time the market to benefit solely from that short,
Yes,
because you're also long in the market as well." So without confusing people too much, it's not necessarily the benefit is not necessarily, "Oh, I've made heaps of money." It's, I've actually reduced a lot of the
the
volatility
volatility.
on the way down. So
Yes,
your long portfolio might have lost a little bit, but
yes,
your short portfolio might have made a lot
yes.
and offset that. Overall, you might be down a bit.
Excellent. That's the way it works,
Yeah.
right? So that's a perfect way to describe it. You look at it, and this is why we say we're not interested in predicting the market. What we're doing is preparing the portfolio for any blow up,
Yeah.
right? So you can say, oh, for example, you got, $10,000. Oh, I've got $7,000 in the index long,
Yeah.
right? But I'm also short for the remaining 3,000. So if the market blows up, let's say 50% just for ease.
Yeah.
Okay, so your 7 goes to 3.5. Oh my God, that's terrible. But your 3,000 goes to 4,500,
Mm.
right? So instead of looking at a really big loss, you're looking at a smaller loss. And that's where you actually say, well, I benefited from the event because now I can pivot out of my short side
Back
back
in.
into the long side,
Yeah.
right? But like you say, the main point is saying, well, I didn't put 10,000 in the market and lose 5. I
Mm.
put 7 in and lost 3.5, but I made 1,500. So
Mm.
I'm only down
Two.
2,000.
Yeah.
And the important part is this. I've now, instead of saying, well, I've only got 5 grand, I've got to wait for it to climb back up. What you're doing, I'm going to do a calculation in my head. It's 3.5 and what do we got? 4.5 and 3.5. I've got 8.
Mm. Mm.
So you can compound again because you haven't, remember that volatility drag stuff, right? So you look at it and go, oh man, I'm going to have to wait 10 years to get back to where I was. Whereas in this scenario, you can say, oh, all right, I only have to wait, 2 years,
Yeah.
right?
Well, it's hard for people to comprehend, because most people see they measure the markets in years and they go, "Okay, I made or I lost this
Yeah,
year."
yeah.
But what we say is, like, especially when we work with people, you look at the portfolio over an investing career.
Yes,
And if in the down years, because everyone has them, you lose less than most, then that puts you in such a better position
exactly.
long term.
Exactly. Yep. I did it today. I went in and said, if you compound 10% per year for 30 years, but in any one of those years, you lose 50%,
Mhm.
right? Okay. If you compound 10% for 30 years, I used $1,000. and it ended up at about 15, somewhere around there, about 16 grand,
Yeah.
right? Okay. If in one of those years you lose 50%, you end up with about 7,000,
Mhm.
right? Now, that's a bit by the by, right? That's easy mathematics. Now the point is, okay, how do I get back to compounding at 10%? It takes you 991 years, right? Because your compound rate has now fallen from 10 to 7.5. 7.7, don't hold me to it. But do you see what I mean?
Yeah.
It really damages your long-term wealth by losing that money,
Yeah.
right? Whereas if you said, yeah, look, it was terrible, but I had put options on the stock market and they, absolutely bloomed. And then I transferred the money to go long. That's the way you do it,
Yeah.
right? You've got to, like you said before, you've got to avoid those losses. And with the cape at 42 and a half, you, you know, if you look at history, things haven't turned out too well over the next decade. So you've got to be able to say, okay, how do I, in a way, make my portfolio anti-fragile,
Mm.
right? Or in the minimum, make it robust.
Yeah, I mean, there's never been a better time to ask that question either. Like, there's
Absolutely.
probably 2 or 3 opportunities in an investor's career that where you can look at a
Yeah.
market and go, "All right, we've got to make some big
Yeah, I got
calls
to
here."
really make some calls
Yeah,
here.
especially when you got. I mean, we talked about it last week in the normal episode. Superannuations on the line that are
Yeah,
heavily
yeah.
exposed in the US market.
Yep.
Like, even if you just go from a fragile to a robust portfolio in your super,
Yes.
you'll be thanking yourself when you're on the beach in the Bahamas when you're retired.
Absolutely. That's the importance, and I always harp on about this. You've really got to think about how you think about time,
Mm,
right? It's really important because if you don't survive, time is irrelevant,
yeah,
right? Because the coffee cup falls over, it smashes. Come back in 20 years, doesn't matter. The coffee cup's dead. It died 20 years ago,
yeah.
right? If you're robust, you can at least say, okay, that was really bad, but I can
White knuckle.
recover.
Yeah, you hold on.
Yeah, 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 right. Hey, that coffee cup fell over 20 years ago, but I still got that sucker, right? It's just got no handle,
Yeah.
right? So you can recover. The anti-fragile is the part where you go, I remember those events and I benefited from them, right? By being anti-fragile, right? By having that framework and adopting those anti-fragile sort of, what we'll talk about, the principles, right? Which Taleb sort of calls it the philosopher's stone,
Yeah.
right?
Well, let's go through them now because there's a few points. I think there's 7 points or so,
Yep.
and then we can talk about the barbell or the barbell strategy. So in Taleb's Philosopher's Stone, it's a metaphor for a small, I'm verbatim reading this now, a small reliable method that converts uncertainty, randomness, or risk into something beneficial. So turning volatility into advantage rather than merely surviving it. So in practical terms, those ideas compress into a set of operational principles. The first one being embrace anti-fragility,
Yep.
if you want to cover that.
Okay. So what you want to do, and this is, but just by the way, we've got all this in a paper, folks. So if you want the paper to read and refer to it, just drop us an email. Um, Embrace anti-fragility. Okay. What that means is take that approach where you don't lose, right? If you know people like Taleb or Ed Thorpe, Warren Buffett, what they're doing is saying, I don't worry about the upside. I just need to avoid the downside,
Yeah.
right? Hey, Warren, we've got this really great company. It's going to make millions. Nah, too risky, right? Ed Thorpe was extreme like that, is extreme. But the point being is it works,
Mm.
right? When you say to yourself, right, the first thing is I'm not losing money, you take a really different approach to investments instead of being a little bit like, yeah, it should be all right.
Yeah,
It's like, no, 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 don't do that.
and the way I think about it as well is that there's a few stages in your investing career. There's an early stage, which is I've only got a bit and I'm going to risk it all.
Yeah, yeah,
Then
yeah.
there's a middle stage, which is I've got a lot now. I've got way more than I did,
Yep,
but I want a lot more because I need to retire.
yep,
And the final stage is I've got enough. I need to retire, and now I don't want to lose
Yeah,
money.
and I want to protect it.
Yeah, and this way
Absolutely.
of thinking at the end needs to be applied here.
Yes, 100%.
Yeah.
And and I was just talking to shout out to Sam down there on the Gold Coast today about that by saying it's um what is it? It's paradox that you make money by not losing money,
Yeah.
right? And it's hard to grasp, right? Because when you want to learn about investing, you don't go, no one's ever rung me and said, "Hey Steve, like I really don't want to lose money. That's why I want to do your course." Right?
Yeah.
People mainly come to us and say, "Hey, hey, teach me how to make money."
Yeah.
Right? That's the general idea. I don't know. Look, I could be wrong, but I don't know whether we'd have a great sales record if we said, "Hey, come to us. We'll teach you how to not lose money." People would be like, "Oh, okay,
What are you
cool,
talking
bro."
about? Yeah.
But
You
it's
gets
really, really
boring.
important, right? Because this is where the volatility drag and the black swan events where you lose 50%. That's why, after that's where you go, okay, I may probably need to focus somewhere different.
Yeah.
And again, if, you know, they fob it off as like, oh, it's bad luck and nobody could have predicted it. But that's not really the point. The point, as we say, is having a framework which is built around not losing money.
Hmm.
Not, oh, you can't predict the bad times. It's like, yeah, I know that, but I'm going to make sure that if a bad time happens, I'm covered,
Yeah.
right? Whereas the finance industry, I don't believe do that. They're much more of like, you know, the standard line is, well, Steve, you can't predict these things. And it's like, well, no, but you can prepare for them,
Yeah.
right? And that's the really important point. It's saying, I'm going to focus on not losing money. And then you can explore how to do that through asset allocation,
Yeah.
through rebalancing. Oh, okay, well, maybe I should take some money off the table. Oh, maybe I shouldn't allocate, my 100,000 to 25 junior mining stocks,
Yeah. Yeah.
right?
Yeah.
That's the sort of thing you want to break, which is embracing any fragility, right? That's the main target to start with.
Yeah, like I said, people apply that way of thinking too late in their career once the
Yeah,
superannuation's got
yeah.
the job or they've been through a bull run.
Yeah, yeah,
But there's a lot of
absolutely.
people that are starting now
Yes.
that are 25 now, and they've got probably a decade of really bad returns
Yep.
coming. So it's a good time to think about it. Anyway, point two is prefer optionality to prediction. So prioritizing strategies that keep many low cost options open so you can benefit asymmetrically from positive surprises while limiting downside.
Okay. This is an in-depth point. I won't go into it in depth. Basically, what Taleb is saying is think about options, right? And this is partly with the optionality, right? So what Taleb is saying is, look, prefer optionality to prediction. Okay, don't make any predictions,
Yeah.
right? But what you want to do is say, Jacob, what happens if the market explodes higher, even with a CAPE of 42,
Yep.
right? You might say, well, that's all right, Steve. I've got some call options
Mm.
that if the market explodes higher, I'll make lots of money. Okay, cool. Right. But you're not predicting where the market's going to go.
Mm.
Now, if I said, oh, yeah, but Jacob, what happens if the market plunges 40%? And you reply, well, that's all right, Steve. I've also got some put options.
Yeah, or if I use my own scenario where I can say, okay, I've got 30% invested to the long and I've got 70% invested to the short.
Yes.
I'm happy because
Yeah,
my
yeah.
volatility
I'm
is going to be
covered.
quite neutral over
Yep.
the next chapter anyway.
Yeah. Again, what you're doing, what Taleb is saying is, so you can benefit asymmetrically, right? Means, like non-linear, like a big jump,
Yeah.
right? From positive surprises, right? While limiting the downside.
Yep.
Okay. So again, it's really about a little bit being an active investor, moving your asset allocation around by saying, for example, gee, the bloody Cape's at 42. This is crazy. I'm going to sell down lots of my stock, put it in cash. So if there's any negative surprises, I'm covered.
Yeah. Yeah. And Tom would say if he was here, that's not advice.
That's not advice. Shout out to Tom.
And the next one's skin in the game, which you covered just briefly then. So require that decision makers bear real consequences for their choices. So incentives align with tail risks, not imposed on others. So just before you talk about that, that happens in inverse for people in the industry, finance people in the industry.
Yeah,
They've got incentive skin in the game to say just dollar cost average.
that's exactly right.
So it's important to have to also recognize that, but think, okay, well, in my super, you might not have much invested in ComSec, but you've got 50 grand invested or 100 grand invested in your superannuation.
Yeah.
You have skin in the game.
Yeah, yeah. It's really about saying, and this is often a tough one because, when you make a lot of us want to make, but if we get bad decisions, a lot of us want to blame somebody else,
Yeah.
right? And it's easy to do. Nobody wants to say, Jesus, I was a real idiot for buying that stock.
Yeah.
You'd rather say, oh, the market went down or something like that, right? I.e., no one can predict these things. Well, that's partially true. But what you can do again is if you look at history and go, Jacob, you kind of said you couldn't predict it, but mate, I've had a look at this chart and every time it's reached this point, the next decade's been really awful. It's like, Steve, you can't predict it. And it's like, yes, you can. Have a look at the chart.
Yeah.
So, but if I'm benefiting from that and I'm not losing, but you're losing, then that's not skin in the game,
Yeah.
right?
Yeah.
That's really, and again, it's just saying if we can all predict stuff, right? It's really easy. I can make 100 predictions, but if you lose from it and I don't, that's really unfair,
Yeah.
right? And it's not all of the industry, but the incentives are misaligned, right? In that sense. So if I say to you, hey, Jacob, buy XYZ and you buy it and then you lose 10 grand, but I don't lose anything, that's a
Mm.
bit like, well, hang on, Steve, you didn't have any skin in the game.
Yeah. It's like the newsletters that people subscribe to, the stock picks.
Yeah.
You're like, well, the people writing those newsletters probably don't have anything, and I'm just speculating, obviously,
Yeah.
but probably don't have anything invested.
Yeah. It's a
So
little bit, excuse me, it's a little bit like, and I'm not saying this as a general rule. It's one those things where you see real estate agents or buyers agents will say this is a really great property, you should buy it, but it's at the top of the market,
yeah,
right? And stuff like that. So, it doesn't mean they're wrong, but the 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 returns are asymmetrical, right? And it's the same with at the moment with Cape at 42. Could it go to 50? Absolutely. But if it falls a lot and you're still in the market, you're going to get caught,
mm,
right? So that's where it's a bit of a problem.
yeah, yeah. And the next one is avoid fragile over optimization. So reject complex, tightly optimized systems that break catastrophically when reality deviates from models. Favor redundancy, simplicity, and slack.
Yep. Okay. It's, this is a bit deep, but they talk about having the optimal portfolio, right? Risk and return, right? All that sort of stuff. I won't deal with that too much. All I'm saying on that point, if I came to you and said, Jacob, I've got this investment strategy and it's got 42 variables,
Yes, yeah.
you're going, that's a lot of variables.
But it sounds smart, which is what people fall for.
Absolutely.
It's like when it's like trend following or candle trading or something like that.
Yeah, yeah, yeah.
On a 5 minute chart, you go, well, you need a trend line, an RSI, and a MACD, and you need the
The
Doji
RSI,
yeah,
yeah.
whatever else. And you look at it and go, well, he must be right because
Yeah.
he knows all these
A
fancy
lot of
words.
lines on the charts.
Yeah, but in reality, you don't need any of that.
Yes, that's true. And that's why he talks about over optimization. What often you find is you might find something that works. We talk about this in systematic investing. What people don't realize is algorithms are actually really good because there's no emotion to the algorithm. Right? The algorithm doesn't go, "Oh, market looks rocky." The algorithm just says you said buy at 60, sell at 70, right? And buy at 58 and sell at 64. Right? So it doesn't have any emotions to it. So from that point of view, what happens is people look at that, they get a system, and then what they think is they can add to it, right?
Like
Rather,
layer it.
yeah,
Mm,
people instead of saying the algorithm is optimal, as in, i.e., it's the floor, it's the ceiling.
yeah,
What people do is say, no, 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 it's the floor, and I can add to it.
yeah. I
It's
can
like,
tweak it.
no, just leave it alone,
Yeah,
right? So in that sense, if you look at Warren Buffett, it's always been his one way of doing it for 80 years. He's never varied. It's really simple. Buy good companies that have got a moat,
yeah,
wait for the fat pitch, all that sort of stuff. But it's actually really simple, right? It's not complex.
mm.
And that's why, as you say, if you get complexity into it, some people are bedazzled by that.
I always say to people that call us like, they say, "Oh, it sounds really simple what you guys do." Yeah, complexity is a sales tool.
Yeah, yeah, yeah.
Complexity is something that is used across not just the finance, in every
Yeah,
industry,
yeah,
to make you go, "Oh, well, I can't do that.
yeah.
I need to pay you guys to do that."
Yeah. And part of it too, Jacob, is a lot of it is language, right? And I got a family full of lawyers, right? So when lawyers speak, it's like, oh my God. But
Yeah.
then when they translate it to normal English, you go, is that it?
Yeah.
And it's like, yeah, that's all it is. It's like, oh, right, okay. All right, well, why didn't you say that in the first place? Partly because I have to show you that I'm a lawyer.
I'm smart.
Yeah, I'm clever. I know the law,
Yeah.
right? And I'm going to use law words where you're going to go, geez, I don't know what that word is. It must be important.
Uh,
And it's the same in finance.
we know money words.
We know money words, right? And people go, oh my God, they must know what they're doing because they know all those money words,
Yeah, yeah.
right? And it really is like that. When you explain it simply, it's a bit like, and this is why I say, you look at the stock market, the bloody thing can go up or down.
Mm,
It's not really over,
yeah,
it's not like, hey, this is really tricky.
yeah,
It's like, really? How many outcomes? And it's like two.
yeah,
And it's like, really? Is that it? It
yeah,
can go up or down. It's like, that's it.
yeah. So build a portfolio that can withhold it.
And that's what I mean. And the benefit of the anti-fragile thinking is you can say, well, actually, I can go long and short,
Yeah.
right? So again, you can say, well, I don't care if it goes up or down. I'll be covered. It's like, cool.
Mm, yeah. And when it's cheap, we'll have more in the long, and when it's expensive, we'll have more in the short,
Yep.
or more in protective cash bonds, something like that. All right, last two. Bear with us. So respect tail risk. So extreme events matter far more than thin-tailed thinking assumes. Plan for them rather than just estimate. So estimating average. So we've talked about that. It's about planning for the catastrophic event,
Yeah.
even if it's only a couple of times every
Yep.
decade.
Yep. It's what Taleb is talking about there. He's got a book out, the statistical consequences of fat tails. It's a great book, but please don't buy it. But what he's saying there is, I'm trying to think about how I can explain this easily. Okay, the way to, I'll use height as an idea. I'm 175 centimeters tall, right? That is the average height. Now, there'll be guys who are 2 meters tall, and there'll be guys who are 150 centimeters, right? But I'm in the middle. We tend to have that bell curve shape, right? Most blokes are, 175, 172, maybe 180, that sort of stuff. You got you got the basketball players
Yeah,
at 2 meters,
yeah,
and you got the jockeys at 145, 150, right? Okay. What Taleb is saying is, in the market, you get a lot more average days, and you only get a few NBA basketball players,
yeah.
and you only get a few jockeys, but they have a huge impact, right? So instead of this gets into fat tails and thin tails, but essentially what he's saying is those really big 50% losses,
Mm.
they really hurt.
They happen at the market extremes.
Yeah.
So if you're at a basketball party and you drink too much, you're more than likely going to get knocked out by a big 6'5"
That's
player.
right. Yeah, yeah.
Whereas if you're at a normal party,
Yeah,
it
yeah.
might not hit you as hard.
Yeah, yeah. So it's also too, it's essentially saying that the extremes are what matters,
Yeah.
right? Both on the upside and the downside. Um, but point being, what we're stressing here is in terms of anti-fragility, is saying you want to really avoid those. You want to really avoid those big 50% losses,
Yeah.
right? And that's why we've been sort of talking about CAPE at 42 and a half and saying to people, look, I don't know when the basketball dude's going to walk in the room, but every time we've been at this position, he's, a pile of them have walked into the room,
Mm,
right?
mm.
So again, it's really, really important not to predict, but just to say, look, we've looked over history and every time we've been at this level, we've had, a decade of really bad returns. Could this be different? It could be, but gee,
It's unlikely.
we've got enough data to say it probably won't be.
Yeah.
Um, but again, just looking at it saying, you know, well, let me give you a perfect example. If you compound at the quote average return, that's at let's say it's 8%, right? Okay. Well, if you ignore that and you get one streak where you compound like Warren Buffett at 20%, you're going to be a hell of a lot richer,
Yeah. Yeah.
right?
And I mean, average returns are meaningless anyway because they always come in market cycles.
Yeah, yeah.
Like it's not if you went in a straight line for 7% for 50 years, like that is just, that doesn't exist.
Yeah, yeah.
That's
No one's done that.
no.
Even Buffett's had 50% down years,
Yeah.
which tells you how insanely miraculously good he is. If he still compounds after those, I think he's had two or three of those, and he still compounds at 20%,
Yeah.
which means he finds investments that just go nuts.
I'd love to be Buffett.
Yeah.
And the final one, and I can get this word right, I had to look at it.
Empiricism.
Empiricism over speculation.
Yeah. Basically, what he's doing there, rely on robust heuristics. Heuristics are shortcuts, right? So CAPE is a heuristic, right? And it's robust, right? Okay, plenty of data there that says, hey, when it's low, buy a lot. When it's high, maybe sell a lot or
Yeah.
reduce your allocation or go short,
Yeah.
right? Hedge, keep a lot of cash. Experience and historical stress tests rather than fragile predictive models. He's getting a little bit into valuation at risk and financial models there, but historical stress tests. So again, if you use history as a guide and say, look, history fairly well repeats, you look back and go, man, every time CAPE's been this high and investors have been crazy and the tech sector's going gangbusters, geez, it never really ends up well.
Yeah.
So that's where, again, and hence the reason why we're talking about developing an anti fragile portfolio where you can say, okay, gee, I'm not sure. So if you said to me, look, Steve, that's really good, but I'm not sure,
Mhm.
then what you might want to do is you might want to look at history and say, oh, if you bought some put options or oh, if I went heavily into cash, I'd probably do all right over the next 10
Mm.
or 20 years, not by making money, but by not losing a lot of your money,
Yeah. Yeah.
right?
And it's particularly prevalent now with so many in Australia with so many Australians that have made a lot of money from property
Yes. Yeah.
and
Yeah.
that cycle. I mean, we're getting people reach out to us going, "Hey, we've just sold a couple of properties. What the hell do we do now?"
Mm.
Because they're in that kind of late stage mindset of I don't want to lose
Yeah.
this.
Yeah. Well, it's naturally as you get older that, loss aversion kicks in,
Yeah.
right? And this is why it's devastating for, like I'm 63. I couldn't afford to lose a lot of money because it'd be like, oh man, it's not like you where you could go, that was a bugger. I'll go out and work and get a job.
Yeah.
Right. So again, that's where you've got to look at it. And like you said before, paradoxically, people like you should invest like people like me
Yeah.
because you're saying, well, Steve, I don't want to lose any money. If you don't lose any money, as I demonstrated before, if you compounded at 10% but never lost any money, you end up with plenty of money.
Yeah, sorted.
It's those big losses that kill you,
Yeah.
right? And that's where you say, I think it's time I started to look at this anti fragility kind of gig,
Yeah.
right?
That's good. I think that's probably a good line to end it on. Is there anything else you want to cover?
No, I don't. No.
We might need to do a part 3.
No. Look, if you do, I would highly recommend people read Nassim Taleb.
Yeah.
If they don't want to read him, he's got a bit of a quirky style, but it's very readable.
He's great. He tells it how it is, which is what I love about him. He just
It's
straight down
not
the middle.
boring. He spells it out pretty clearly. I would read his books in order, right? Fooled by Randomness, The Black Swan, Anti-Fragile, which I think is his best work. Then he's got The Bed of Proscratius. It's, little aphorisms. You could flick that. And the last one is The Statistical Consequences of Fact Tales, which is a really technical book with lots of graphs and charts and statistics. It's kind of helpful, but I really think if you spent every year rereading Anti-Fragility, you'll get it, and it's really good. Either that or watch him on YouTube, right? Follow him on Twitter, those sorts of things. It's a really, really good education process. And the reason why is if you learn it at your age, you embed it like Warren Buffett embedded his value philosophy at an early age, you'll end up generally making more money because you understand that baseline is saying, how do I avoid losing money?
And you avoid the silly mistakes that people
Absolutely, 100%. And the mistakes are always your own.
Yeah.
Right? From the dumb things that you do. You get too greedy, you get too fearful, right? But it's mainly being greedy, right? And if you have the ability to say, I'm just going to take some money off the table and be comfortable with it. And if it goes up more, I'll take more off.
Yeah.
Right?
Yeah. Easier said than done, hey?
Yeah. Mate, it took me 20 odd years to work that sucker out.
All right. Well, thanks for your time. We'll see you guys next week.
Cheers, folks.